Stocks a little quieter this morning, but still some red as we begin the session with the Russell down 70 bips, coming off a rough day yesterday. Question is, what happens if markets do break further? Joining us this morning, Rebecca Walser is the president at Walser Wealth Management from the New York Stock Exchange at our site down there. Rebecca, great to see you this morning. Thanks for being here.
Thanks for having me, Oliver.
Last couple times, I think I watched your interviews with Nicole. You were looking for a little bit of volatility, pretty cautious on the market. Tell me what you think's happening. Is some bearish framework coming to reality here?
Yeah, I mean, I think we're absolutely experiencing a global pullback. All we have to do is really look at Q3. We had the largest Treasury sales from Japan, and actually the largest sales on record ever. Japan sold just under $62 billion worth of U.S. Treasuries. China sold $51.3 billion of U.S. Treasuries. These are the first largest and second largest one-quarter sales of U.S. Treasuries by foreign holders ever. So we start to see that the strength of the U.S. dollar, Oliver, is really causing problems. You've got Japan that's doing a 39 basically $1 trillion yen intervention to keep that going, and it's not as much as we saw in August with the reverse carriage. And I'm not saying that. I'm not saying they're getting interventions, but they are stimulating, and so is China. We know PBOC is absolutely doing a lot of stimulus and cutting rates. So you've got Asia in a very, very weak spot. You've got Germany in a very weak spot. So we know that that's coming here. And as much as we want to say a soft landing, we can technically say is achieved because of the labor markets and all of these things. We are seeing softening. And look at the auction that we had just yesterday, $39 billion on the 10-year, Oliver, and it was a mixed result. So as you see the strength of the dollar continuing to give the rest of the world such a problem, you're talking inflation, you're talking that it's going to rear its head in 2025, which will be an issue for the markets if they're expecting the Fed to continue this stimulative, easing type of mentality with cutting rates and even maybe doing some QE instead of QT.
I think it's a pretty great observation to start with the foreign demand waning for treasuries. We've also heard arguments here on the show from some bond bears that pension funds kind of fully rebalanced to when yields were closer to 5%. So what do you think is possible here for yields, Rebecca, and where will those buyers get interested again in your mind?
Well, I mean, I think the United States is going to have to realize, and we're talking about Trump potentially declaring a national economic emergency using something called the International Economics Powers Act, the IEEPA, to implement his tariff policy. So then you've got protectionism coming in. We were looking at China retaliating against that protectionist stance that Trump is announcing, talking about any kind of dual use. They've already listed 28 companies that they import or export dual use products that can have a civilian use, but also a military use, and they're saying we're not going to ship those anymore. You've got them sanctioning 17 companies in the last 2 weeks for basically selling military parts to Taiwan. So you've got a lot of things happening with Trump coming in that are protectionist based, that we're seeing China being a lot more aggressive, Trump 2.0, that they are retaliating very quickly as they did not do necessarily in his first term. So when you've got all of those macroeconomic headwinds in a globally slowing world, you're going to see problems, and that is going to roll over into equities, and people aren't going to see, and to your point, you just had the whole segment on AI and quantum computing. It's not monetizable immediately, and so as people realize this is a longer runway than they expected, then the actual irrational exuberance, kind of like the dot-com fervor, if you will, is going to pull back, and that will relax the market's levels right now.
So take a few things there to break apart then, Rebecca, because it sounds like you have kind of doubts about some of the viability of these really juicy valuations and tech stuff, and that seems like a very reasonable argument. If we put that aside and go back to just the economic one for a moment, do you see upside in interest rates, yields as being the spark for investors to calibrate away from stocks, or do you see the slowdown elements of the economy weighing in like a more recessionary standpoint? Because this morning, again, we got pretty good jobs data here. Like, we keep surprising generally to the positive when it comes to the U.S. labor market.
It's true, but then look at all of the times we get BLS revisions. We had the second largest amount of revisions in the last 18 months than we've had since the dot-com, the global financial crisis, the GFC in 2008, 2009. So I will just say that the labor market gives us great numbers and the equity market rejoices, but then they come back and say maybe it's not so great. You know, the fact is that I think the Fed has a problem because they're getting out away from control. In other words, they started saying at the end of last year, hey, we're going to have 6 cuts going into 2024, and we know, Oliver, that was reduced to 3 because the market was, they got ahead of their skis. The market wasn't going to have it. In fact, in 2 of the last 3 cuts, the second that Powell cut, within a day, the yield was above the pre-cut level. So I think Powell and the Fed has to really be a lot more cautious and say we do not want to start pronouncing what we're going to do, and then we do it, and the market just disregards it as irrelevant and is right back up to those levels. And so when what's happening, Oliver, is the cost of us, the debt. We are literally 100. We're just in 100 days. We're at $1 trillion of additional deficit spending. We are increasing our debt now exponentially faster. And if we do not get a handle on this, you're going to see some kind of debt spiral. And so what I'm talking about is that we are looking at a divergence of interest rate and yield policy on bonds that is separate and apart really now from where the Fed policy wants to take it. In other words, the risk is becoming so large with how fast we're spending money in the United States that we are going to start seeing a risk curve that is more important than what the Fed policy is.
So do you think, Rebecca, let's say if stocks keep coming off right now, do you envision stocks, the downside for stocks correlating with higher yields or lower yields right now? That's kind of the brass tacks intermediate term trading question I'm trying to get at is, do we get like a 2022 environment? Is that what you think is going to happen, where the Fed might actually have to hike, you get yield curve inversion, but yields go up and stocks hate it, stocks and bonds sell off? Or do you think this growth stuff overweighs us, people just start dumping equities and maybe that'll cause some bond buyers?
You know, I do see, to your point, that 2022 could be a little bit more of an alignment with 2025 simply because the risk of how much is getting printed in the bond market is going to be detrimental. And then you're going to have institutional investors, you know, they're going to be in the place for fixed income, you know, Oliver. But at the same time, they too are going to have to start to worry about, similar to them worrying about state solvency of like California, Illinois, state solvency of bond funds, where they're going to have to look at, can we continue to just really use a treasury policy with the amount of risk that really is coming into the bond market?
Dollar says that whatever problems we might have, seems like they're still the best ones around the world. Rebecca, that's kind of the, I guess, counterpoint is, even if we're printing and we're running it up, everybody else did during COVID, except their economies didn't keep up. So we stimulated and leapfrogged everyone. So where else do we go?
Yeah, but Oliver, I 100% agree with that, and that is absolutely true. But that statement is on the precipice of being untrue, because remember, we're able to export our inflation to the rest of the world because they have to buy U.S. dollars for OPEC and crude and all of that. That is changing with the BRICS bloc, with Project Enbridge, with everything that is going on with de-dollarization, cross-border payment transactions on the rest of the world. We are really moving into multipolarity, and there will be currency alternatives to the dollar very quickly. And so we cannot rely on the fact that we are the world's reserve currency forever, and that is getting more and more obvious as this BRIC bloc really goes into payment, bi-directional payment processing between countries.
How will we know? Because right now the chart of the dollar pretty clearly says otherwise, Rebecca. 109, 114 was the high in 22. That's basically the highest, second highest in like 10 years. So far it's going the other way.
I think how we know, Oliver, is when you see Japan having the largest amount of sales of treasuries ever in the history of one quarter, China in the same quarter, Q3 of 2024, the second largest, when you know that collectively of 800 billion, which is the largest amount of treasuries, the lowest amount of treasuries they've had collectively in 16 years, when you see that it is too expensive for these countries to continue to operate in U.S. dollars, they have to get an alternative as fast as they possibly can, and that is what's driving them away from the dollar.
All right, Rebecca, I feel like a lot of times I hear this case from someone that ends up with a gold or a Bitcoin pitch. Are you in one of those camps?
I mean, I absolutely believe that gold is a long-term hold, but I believe that it will, as you know, you have to remember, Oliver, we're opening bell, right? Gold outperformed both the NASDAQ and the S&P in 2024. And so when you see that, you've got two things happening there. You've got Basel III being implemented, so actual capital requirements on tier 1 asset classes of bank balance sheets. That's happening. That's Basel III. So you've got that, but then you also have de-dollarization and a lot of countries wanting to have reserves that are outside and apart from the U.S. dollar, more in an actual physical asset class like gold. So gold is still going to have a great run in 2025. And if we get market pullback in bonds and equities, you will see commodities take off. Absolutely.
All right. Gold this morning up 0.5%. I do think it bears watching for sure if any of our recent bullish regime starts to fray more. Thanks, Rebecca, taking us through the bell there. Yeah, pretty poppin' start there for the bell at the New York Stock Exchange. Nice job, Rebecca Walser, closing that thought out for us. Walser Wealth Management, the president. All right, with a bear case centering around the potential for de-dollarization and markets looking elsewhere, perhaps for investment opportunity.